Every time this chart goes under zero, Kevin's saying we're in a recession. It essentially says we're screwed.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
This is not good. We need to call a spade a spade. There's a chart, a current economic indicator chart that averages together 12 economic indicators, and it essentially says we're screwed. We have a recession that we're dealing with. Let's call a spade, and let's address this head on. So first of all, the chart that we're going to address, I'd like to mention that it was brought to me by a course member. So shout out to them. They brought it to me this morning in our course member live stream, private course member live stream for over an hour. And one of the reasons they brought it is because I've been asking everybody to find me the most bearish information that they can so that we can analyze it and understand, okay, where does this mean we are in the economic cycle? Should we be thinking about buying real estate? Should we be thinking about buying stocks? Or is it better to wait because more pain is still ahead of us? And so I'm going to bring up this chart and explain it. But let's just start, again, calling a spade a spade. It starts off bad and bearish. Let's analyze it together. Do keep in mind that on the 18th, which is Friday, we have an expiration for the coupon code linked down below. Remember, you can get the courses by going to meetkevin.com, or you could get stacked with a stack hack by going to stackhack.com. This is licensed financial advice. We'll have a price increase here. We're almost booked out with how many portfolios we need to get through already. So we're going to have some really high quality work, many hours of analysis going into everybody's personal financial situations for those who want licensed financial advice. And if you want the perspectives on building your wealth, the self-study with the course member live streams, that's right here. And these are absolutely incredible. So make sure to check these out. There are, let's be real, incredible ways that you're going to be able to build your wealth in this next cycle. And you want to know what those are. So even if you learn one thing, I expect you're going to pay for your course 10 times over with the value that we can provide in these courses. So let's get to this particular chart. The chart that we're going to look at is the current economic indicators chart. It's basically an average of about 12 indicators, and we'll look at the weightings for these in a moment. But as you can see, this particular chart here goes from 2023 all the way back to 1962. And the first thing that I did when I looked at this particular chart is I wanted to know where the zero number is. So I went ahead and added the zero number as this red line going across. And then I thought, okay, well, it is decisively negative. That doesn't look good. That actually looks quite bearish. Now what we should do is we should circle every single time we went into a recession and see if there's any correlation between this chart and recession. So we'll go ahead and circle that in this blue marker here. So first of all, we know that we went into a recession right here because we had the COVID recession. Then we had the 2008 housing market crash. Then we had the dot-com crash. Then this was sort of like the 91 recession, which kind of came after the savings and loan crisis, some of the built-up speculation from then. And then you ended up having your 90-91 recession. It was deemed a relatively shallow recession, followed actually by a soft landing in about 94. But you notice that even in 94, which is about right here, where you had this steepening, you didn't actually cross that zero level for the soft landing. Don't mind where we sit right now. Anyway, then you had your basically your 79 and your 81 recession right here, your mid-70s recession, and then of course your 69 to 71-ish recession. So if you look at the chart now, it's kind of like, oh, well, every time this chart goes under zero, Kevin's saying we're in a recession. And where do we sit right now? Below zero, and we're technically not in a recession. Great. So what does this also tell us? Well, what this chart also told us, upon further analysis, was that most of the time, this chart inverted out of a recession was at a very particular point. I'm going to draw those points to you to kind of bottom line it, and you can fact check it and kind of see it yourself. But right here, and watch what I'm doing. This is when we were within 3 months of the end of the recession where I'm drawing. You kind of see the pattern already? If you don't see the pattern yet, it should be pretty obvious here. There we go. Now this one was a little rougher, so we're actually going to do something more like that. Okay. And then over here, and then over here. So what do you notice? Well, the near end of a recession was typically where this line started going up again, with the exception of 2001. We hit the bottom in the fourth quarter of 2001. We still had about 90% or 9 months of pain ahead of us. The NASDAQ fell 40% in those 9 months. Now, worth noting that in the early 2000s, the NASDAQ behaved kind of like an index of SPACs because, quite frankly, these were newer, not profitable companies. But some people argue that the companies making up the NASDAQ today are newer and unprofitable and are going to have their earnings smashed. So anyway, you have this precedent in 2001 that stocks could still fall 40%. But that was the NASDAQ, okay? In all of the other cases, the inflection of this indicator actually aligned with stocks having just recovered or being about to recover, and then basically going straight up from there until the next recession. You can see when you zoom out, it's not actually very volatile. Now, when we zoom into this chart, back in 2001, this actually felt like it had bottomed, started recovering a little bit, and dropped even more in 2002. And so there is a chance that could happen over here as well. But what I got to thinking about was, wait a minute, if this indicator bottoms out when the recession is over and then starts trending up, is it possible that we're actually in the recession or are coming out of the recession that everybody keeps talking about? Imagine that. We know that we had a technical recession in Q1, Q2 of 2022. That was a TR, technical recession. We know that because we had negative GDP. We also know that we are generally not deemed to be in a recession until 9 to up to 36 months after the recession occurs. That's because the economists who decide whether or not we're in an actual recession, yes, maybe they're politically motivated, who knows, but they take a long time and use a lot of data analysis to say, yeah, that was actually consistent with a recession. So is it possible then that economists could tell us that, oh, well, the recession actually was Q1 2022 to Q2 2023. And by Q2 2023, the recession was over, and that's it. The recession that the inverted yield curve is talking about has already come and gone. Is that possible? Well, we should be seeing a lot more of a steepening of the yield curve then, right? We've had some steepening, but not that much. So is that possible that the recession is over before it's actually come? Well, to help understand this, we should look at what goes into this particular chart that we just talked about. These, by the way, were some of the notes that we talked about in the course member live this morning. And if you zoom in right here, this was something that I thought was very interesting. Look at this. I wrote down how interesting that in Q3 2021, you got a sell signal, a fall. And then by Q1 of 2022, you had this slope right here, that portion right there, since this is quarter over quarter data. And it was your second warning to sell. And then obviously stocks bottomed about 3 to 9 months later. Well, what we think is the bottom. Who knows? Maybe we'll get a new bottom. Anywho, so this is what this economic indicator, the LEI, the leading economic index, is made up of. You can see there are two components. There's a financial component and a non-financial component. We are at negative 4.2. However, over 70% of this indicator is being driven by this, non-financial components. So the biggest portion of the financial components has to do with credit. So in other words, tightening credit. But credit will probably loosen when some of these other things turn positive. You also have the S&P 500 in here, which is interesting. So let's ignore the financial components for a moment and just focus over here on these non-financial components. So what do we have? Interesting. We actually have consumer expectations and then the Institute for Supply Side Management Index of New Orders, as well as building permits, although a very small portion being building permits. Most of the weight here, the negative weight, is coming from expectations and manufacturing orders. Now, I want you to think about this. This is the breakdown of the leading economic indicators. Of these, which do you think is the most leading of the leading 12? While you think about that, remember, coupon code expires this Friday. Email us at staff@meetkevin.com if you'd like bundles. You can bundle up even if you want a special between the financial advice and the self-study, course member live streams, lifetime access, Q&A with me, whatever you need. Send us an email. We'd love to bundle you up. So what's the most leading out of all of these? Well, in my opinion, what would be most leading would be consumer expectations. Consumer expectations are important because when consumers and smaller businesses or otherwise think that we're not going into a recession, what expands? Spending, so new orders, because people are like, oh, we're probably going to avoid a recession, so we don't need to save as much. New orders. Credit then starts expanding. Stocks start going up. Risk premia start going down. Then you get all these other things ideally start trending in the right direction as well, although these tend to be smaller weight over here, at least they're presently smaller weight. So the biggest leading indicator of the leading indicator is probably expectations, which makes sense because expectations are frequently self-fulfilling. So what do we have about the Consumer Confidence Index? Well, we have the following. The Consumer Confidence Index shows that consumer confidence actually bottomed here between July and October with Jackson Hole right about here where Jerome Powell really gave us a spanking. Well, in that period of time, a lot of stocks were darn near bottom. So there was almost this alignment with consumer expectations and consumer confidence with the bottom of the stock market, nearly. Some stocks didn't bottom until December. But you notice that once we got into 2023, we actually had pretty bright expectations. And even the AI push, which we really got about here, didn't really push expectations much more positive. The trend was already substantially more positive. Now, I find this very interesting because right now, the consumer confidence level is sitting below 100. 100 is actually right here. So that means we have this deficit right here where consumer confidence is still negative. That means it's weighing down that leading indicator, right? Remember the weights right here. See how consumer confidence is negative? And then you're going to jump over here, and then that negative number helps push us down. But what happens when that negative number becomes less negative? Well, then this becomes less negative. So let's draw that out. Let's say that number trends back to 100, which is the trend we are on right now. Expectations going up, right? What if that trend trends up like this? And then all of a sudden the other indicators start trending up. Well, that's probably why this chart moves in such violent lines. Like it feels like almost straight up or straight down because one of the leading indicators leads the other indicators to flip. Take a shot every time I say leading indicator. Anywho, so what does this potentially mean? Well, I don't know. Let's zoom out. Let's compare consumer confidence today to where it's been in the past. Well, here's consumer confidence today. This is the rebound charted out. And if we draw this over, we could see that we're actually sitting around similar levels of consumer confidence as where we sat in 1980 when we were getting Paul Volcker, and which is not great. And we're sitting at similar levels as to where we were in 2010. Now, I'm going to use the more recent example here. Even though this ended up being good, right? We had a strong recovery after our Paul Volckering. After we got our spanking, we had a strong recovery. We got our spanking so far today. That's probably what led to this massive decline that we have here. But what was interesting about 2010? Well, I'm going to give you an anecdote about 2010. You ready for 2010? I got into the real estate industry towards the tail end of the crash, so I still experienced enough of the crash to see how miserable it was. And it was so odd because people would come up to me and go, we're looking for a 3 and 2. I'm like, I got 100 you can look at. There was so much inventory. We had excess supply. Everybody was afraid because everything was a short sale and foreclosure. If you had a standard listing back there, they'd advertise that. They'd be like, equity sale, standard listing, not a short sale. That was like bragging rights back then. Today it's the opposite. No real short sales and foreclosures. It's like 0.5% of the market. So what's interesting about 2010? Well, in 2010, when I started getting ready to buy my real estate and then started buying my real estate, everybody told me don't buy a house right now. And they told me don't buy a house right now because there's about to be a double dip recession. All of the banks are holding all their inventory back. It's a shadow inventory of foreclosures, and they're going to dump them all onto the market as soon as prices start rising because the banks are trying to rip us off and the suits are trying to rip us off. And everything's rigged. Boy, doesn't that sound familiar to the kind of stuff we hear today? Don't trust the data, everything's rigged, wait for the next crash, the big black swan is coming, the great reset's coming. And then it didn't. And then we had a 10-year bull market where, of course, every single year, the people who got the most views were the people talking about how every single year there's going to be a mega crash. Oopsies. Didn't end up happening. So, bottom line, what does this data tell us right now? Well, the data is actually telling us that we might be at a leading indicator inflection point. Not only may we be at an inflection point, but the recession may have already happened. That may already be behind us, which is really interesting. Now, that does set us up for volatility during the steepening of the yield curve, but the recession may have already occurred. The inflection point is already occurring in leading indicators, suggesting maybe we're already in the recession or we're just at the end of the recession. And that would align with history. Except we won't know if we're in a recession now or we're just in a recession for maybe another 2 years. Whether it's politics or what, that's just the way it works. That we could argue about potentially being rigged. But if that's the case, then that potentially takes what looked like was a bear argument from the course member and actually makes it look like something we need to pay attention to because it could get worse. Or if those leading indicators keep pointing up, we'll inflect up and continue to inflect up relatively quickly and signal that the worst is already behind us. Of course, what can destroy all of this? Well, obviously, a big old black swan. What was a black swan that actually delayed this indicator from recovering? If you zoom into the charts, by the way, you'll see something like this. In 2008, and then you see another crash, and then sort of the recovery. Why did you have this pause in 2008? Well, you had this pause because you had a black swan called Lehman Brothers. That's where you had the real Lehman Brothers collapse, and then you had to flush out the true excesses of the system. Don't get me wrong, I think at some point in the future, we are going to have to flush out all of the excesses. The defaults that need to occur will happen. But I don't necessarily think that we have enough systemic risk at this point that the entire system gets screwed. We'll have bankruptcies, we'll have foreclosures, we'll have office defaults, we'll have funds blow up and companies blow up and go under. But most of the companies, just like property owners today that are set up and prepared for this, will survive, like our mega caps, or like our single-family homeowners who have 30-year fixed-rate mortgages. In which case, the potential for a systemic black swan is actually minimized. Don't get me wrong, those bankruptcies are going to come. But if the recession is behind us, I know that sounds weird to say, and we're at an inflection point to the upside, and this black swan isn't present yet, and if it occurs, it might not be that bad. To some extent, the banking crisis was kind of a black swan, and then we're like, that wasn't that bad. Okay, you took out 4 or 5 banks. We got 4,000 more. Kind of interesting. So, if you like my perspectives, make sure you check out the links down below. We got that expiring code on Friday, and I'd love to learn with you. Join me in the course member live streams every day. The market is open, and we'll see you soon. Thanks so much. Goodbye.
You're here tomorrow to ring the bell. Congratulations, man. You have done so much.
I took my enthusiasm for the market and money and started learning everything I could about real estate I would be the most transparent governor that would exist, and you'd have my commentary every single day. I became a licensed financial advisor.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Always great to have you on. Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.